Ramesh says that when you reach the top, the only way is down. This is what history suggests. So, what should he do uh, in terms of investing a lump sum in equities at present?
Uh, I don't quite agree with him because market has, if you look at Sensex today, what we are talking about right now, in 38 years since it was crafted, the Bombay Stock Exchange sensitive index, it has gone up by 30 times in 38 years. So that is quite a jump. And market touched a new high when it turned when it went up from 100 to 200, from 200 to 400. In 1992, it touched a new high around the Great Indian Scam from 2000 in 1990 to about 4,000 in 1992 by the month of May. So it doubled in that time period. Likewise, for many years the market drifted, everything changed. Foreigners were allowed, a lot of things happened, the economy was liberalized. And today we are at 30,000. I don't know. In 2008, the market was at 20,000. I don't think that this market going up on the Sensex by 50% from a high of 20,000 in 2008 till 2017. This is not an extraordinary return. But there are internal, a lot of Indian investors who have invested in mutual funds or who have invested in a different set of stocks. Their return will be very different. Many funds have actually multiplied investors' money every 3-4 years, even during this period, which means in the last 8 years there are funds which have gone up in value by 4 times, while the Sensex has gone up by only 50%. So I don't quite agree. Equity goes up because equities produce, companies generate more, earn more. The ownership gets priced in the market. The product and services created by these companies get adjusted for inflation, and many companies also grow in size over time for their superior product or services or strategy or design or brands or whatever. There are too many things at play, and that is why we entrust our money to a fund manager to do those evaluation, to make that choice and achieve those superior returns for us. So don't get unnerved. Don't have this notion that markets can only correct from a high, because markets can have always, and of course it can correct. I'm not saying that they will not correct, but it may correct, it may not correct. I don't know what will actually cause that correction, whether it will happen in what time frame, or whether it will happen in the first place. So great deal of uncertainty. What I know for sure is that over the next 5 years, over the next 10 years, money entrusted to good fund manager in a gradual way will generate more return irrespective of the corrections. If you are investing with 5-year, 10-year time frame in mind, you will be better off than any other investment avenue. I don't know how much that return will be, whether that return will be what we have seen in the past, whether it will be more than what we have seen in the past, or whether it will be enough, whether it will be good enough for a lot of people, because a lot of things have changed. When interest rates in this country was at 12% or 13%, which was the risk-free return, you can put your money in a RBI bond 20 years back and earn 12%, 13% return or 11% return. Expecting 20% return from equity was decent risk premium. But if interest rates come down to 6% or 7%, and that is pre-tax, so I just might be happy. I may not be as happy. Things might not be as good as we have seen in the past, but I'll be happy with 12% return. And if inflation comes down to 4-5%, I'll be okay with 10-12% return, which may not look great return in absolute terms, but going by our experience in the past, but that might be quite meaningful for most investors, and most investors will be well off, because all you have to see is, is your money beating, is your investment beating the index, is your investment beating inflation, and if that is doing it over a period of time, you'll be better off.